Okay, so let's go back to this. Now, a lot of people ask, do you think the market will go up? It's just one of those questions that comes up. Well, actually, it's the wrong question. I'll tell you why. I might think there's a 70% probability the market will go up. And this is all to do with risk management. It's all to do with the mentality of a professional trader versus an amateur, somebody who isn't professional, etc., etc. And the issue is this. I may well think that the market is going to go up, and there's a probability. However, the thing is, although I think there's a 70% chance it'll go up, I think it'll only go up 1%, and although there's a 30% probability it'll go down, I think if it does go down there'll be a 10% decline. Then those are two different scenarios, because what you do is you multiply the probability by the outcome return, 70% times 1%, that equals plus 0.7% expected value. 30% times minus 10%, that's minus 3% expected value. The total gives you a minus 2.3%. So somebody could ask me, do you think the market will go up? And I'll say, yes, I think it'll go up, because the odds are that it will go up. Somebody else could then come along and say, what do you think the return will be from the market over the next 6 months, say? And I could say, oh, minus 2.3%. Wait a minute, person number one says, you told me the market was going to go up. I say, yeah, I do. I think it's going to go up. But I think the overall return will also be negative, because I think although it's going to go up, there's only a 1% return on it going up, and although there's a small probability it'll go down, the downside is a lot bigger, so my expected value is lower. Now that's quite subtle, and most traders, professional traders, understand it, but those who aren't professional traders simply don't. What they confuse is, they confuse this with returns. They think probabilities, which is, oh, I think there's 70% probability the market's going to go up, therefore I'll go long the market. That's wrong. That's simply wrong. I can't put it in more basic language than to say it is just wrong. This is the calculation that you've got to look at. And guess what? Financial journalists make this mistake all the time. TV journalists, I'm asked on TV, what do you think will happen to the market? Do you think it'll go up? And I have to say, yeah, actually I do. I think it'll go up. Oh, where do you think it'll be? Do you think it'll go up in the next 6 months? Yes, I think it's going to go up in the next 6 months. Oh, what kind of return do you think you'll get? Oh, minus 2.3%. And they can't reconcile or understand the two. What should a professional trader do in these circumstances? He should short the market. What would an amateur trader do? He'd go long the market. It's really simple. And that's why professionals do the opposite of what private investors do. It's as simple as that. Okay, let's continue and continue looking at some of this very important stuff. Let's look at another misguided notion. You've got two systems. System number one gives you 85% of the time it gives you wins. 85% of the time you make money with this system. Yep, that's pretty straightforward, and there's no issues there. 15% of the time, you make losses with this system. The average profit is $500. The average loss is $1,500. Now, the amateur trader would say, ooh, I can win 85% of the time. I like this system. The professional trader will say, yeah, but what are you winning? You're only winning $500. You only win 15% of the time. What are you losing? Oh, you're losing a lot. You're losing $1,500. The expectation per trade is $200. Look at this system. You only win 45% of the time. That's less than half. Most amateur traders say, oh, I'm not interested. I don't even win half the time. You lose more than half the time. But when you win big. When you lose small. That's more important. Expectation per trade, $400. This system is twice as profitable as this system. Yet, it wins far fewer times. Professional trader understands from a risk and money management perspective, it's the number of wins you have which is irrelevant, it's the amount of money you make which is relevant. This is not directly relevant. It's only relevant because it's that multiplied by this that gives you this. Understood? Have a look at this. Please have a look at this. The number of private investors that I've taught this to who simply did not know it because nobody else bothers telling them. No other professional trader will sit down and say, well, you know what, I'm going to let you into my trading room. I'm going to give you a little secret. This is something we take as read. This is something we all know. It's something we all do. But we've got to tell you. By the way, all those financial journalists, they don't know this. All they do is say, oh yeah, you've got to buy Vodafone or whatever. They don't know this. And so I know I'm dwelling on it and going on and on and on about it, but I'm afraid it's important. And these CDs, they pay for themselves simply by you learning things like this. Okay, risk and money management again. Some more facts, and I love this chart. You've got a stock which has been doing this. It's been going boom, 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 up a bit, down a bit, up a bit, down a bit. No problem. Now, what happens if you bought at this point? And you bought £1,000 worth of shares at an average cost of £10.45. Yeah? At this point. And then it keeps going lower and lower. And at this point, you buy £1,000 more at an average cost of £900. So at this point, you buy £1,000 more at £900. Your break-even has moved from being £10.45, because you bought £1,000 worth of shares at £10.45, to being £972.50. And you think, great, my break-even isn't up here. All of a sudden, my break-even is down here, £972. And you think, great, I don't need the price to go all the way up there. It only has to go here, and I am fine. Sorry, bad news. What have you actually done? Well, you've doubled your risk, because you just doubled the position size in a stock that's falling and that the market is willing to sell at ever cheaper prices. You've just gone and bought twice as much. If there's only 14 stocks in your portfolio and there's 3,000 stocks on the London Stock Exchange, why on earth do you need to, as your next purchase, make a purchase in a stock which has been going lower and lower and lower and which you've got a loss when you've got 3,000 odd stocks to choose from? It does not make sense. Why are you doing that? Now, the reason I raise this point is because private investors mistake winning, that's why they want to reduce their average cost, with profits. What you want to do as a trader is cut your losses very quickly if you don't think this stock's worth having. At this point, what you're supposed to say is ignore whatever position I've got. At this point, risk and money management, you're supposed to say with a clean sheet of paper, would I buy this stock today? Whether or not I've got a holding, whether or not I sit on a loss. Instead, private investors say, oh, I've got a loss, I need to turn it into a profit, I need to make a win on this. That's what they say. And that is bad and that is wrong. Okay, what about this? What do we do if we bought something here and it does all of this and then it just drops? Is that an opportunity to buy more? Because the price has fallen. And again, this is a risk and money management issue. Now, some will say, oh yeah, fantastic. If you liked it at 275, boy, do you love it at 90. You know what? Forget it. All other things being equal, that has been falling. It's going in one direction. I'm not interested. Yeah, tomorrow morning it might jump up. It probably will. I don't care. Tomorrow is not today, and today all the information I have before me, and I can only trade off information, all the information I have before me is that it is going in this direction, and that is that, and end of story, and nothing more. Yeah? Lower, 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 bang. So, where does that lead us? Well, what it means is that you shouldn't buy more. No, it's not an opportunity to buy more, and that is my view. Oh no, look! It dropped and dropped, and then it just shot up. Alpesh, you're terrible. I could have got in at, 90 pence. I might even have got in at 50 pence and tripled my money in the space of a year. How bad are you? You know what? I don't care. I'll tell you why. Because, based on the information I had before me, on the price movements, on the market, and what it was willing to do, this did not look like a purchase. At this point, it might do there, once it's quite clear that it's broken the downtrend and is likely to move higher, but it certainly did not do at any other point. Okay, rule number 3. Remember we had the 2 earlier rules ages and ages ago? Well, here comes rule number 3. It's again about risk and money management, of course, and it's never add to a loser. Pat Arbor was the chairman of the world's largest derivatives exchange and a full trader. He knows what he's talking about. He's been around the block. He's trained traders. He is a very successful trader himself. So I don't care if you don't want to take my word for it. Take his. No averaging or pyramiding down. I just talked about that earlier. No excuses. I don't want to hear, if it was cheap then, it must be cheaper now. Only need a small move to break even. All that kind of rubbish. Think profits. not the number of winners. Now, this is an interesting little game. What we'll do is we'll do this in the next chapter, because I think you need a bit of a break and a bit of a breather from the last one. So I'll see you in the next chapter.